Lorena, and welcome everyone. Thank you for coming to this briefing on ACC's annual report for 2019. The annual report is to be tabled in Parliament today at 2 p.m., and that is why the information is embargoed until that time. We've invited you along today to outline what we believe are the major factors that define the financial year just completed, including ACC's financial performance, key challenges the corporation faced, and significant operational changes that we have delivered. We'll provide an overview, and after that, as was just indicated, we'll be happy to take questions. ACC recorded a $570 million cash operating surplus in 2018-19 financial year. The cash operating surplus demonstrates ACC's robust funding structure that enables the scheme to withstand volatility, particularly with respect to falling interest rates. It reflects the strong performance of the organization during a year that has seen continued strong growth in claims, wide-ranging improvements in services, and double-digit investment returns. The outstanding performance of ACC's investment fund made a strong contribution to the result. The fund achieved a 12.97% investment return, substantially outperforming comparative diversified funds. This added $5.1 billion to ACC's assets and increased the fund's size to $44 billion at the end of the financial year. Part of the fund's performance was attributable to the effect of falling interest rates, both globally and domestically, which lifted the value of ACC's substantial bond portfolio. The trend of declining interest rates, which was beyond ACC's control, also impacted the other side of ACC's balance sheet through a significant revaluation of the outstanding claims liability, which is also referred to as the OCL. That liability reflects the estimated present-day value of all claims costs for injuries that have already occurred. This increased the OCL by $10.8 billion to $53 billion. Including the valuation influences, ACC's accounting deficit is $8.7 billion. This is not a cash loss, and ACC continues to have more than enough funds to cover and support those who are injured in accidents, both today and into the future. We did prepare a short video that is an attempt to help explain the OCL, because it's a difficult concept, and the impact that interest rate changes has had on it. So we'll run that now, and then I'll continue.
In 2019, we recorded an accounting deficit of $8.7 billion. The root cause of this loss was interest rates falling to historical lows, something entirely outside of our control, and we have not been alone. Low interest rates have impacted the balance sheets of insurance companies and pension funds around the world. But importantly, the deficit has nothing to do with our ability to pay for injury treatment, rehabilitation, and compensation costs today. It is not a cash loss. In fact, we made a cash profit in the financial year, which we reinvested. Instead, the deficit relates to the accounting value of the future costs we need to pay for existing injury claims, which stretch beyond this century all the way to 2119. Let's dig a little deeper into the detail. Every year, we support around 2 million claims made by Kiwis for the treatment and compensation they're entitled to following an accident. Some of these people will have recovered quickly and won't need long-term support. However, others, such as a baby starved of oxygen at birth, may require support for their whole life. For this reason, we forecast how much money we will need over the next 100 years to cover the lifetime costs of existing claims. At the start of the financial year, we calculated that we needed $41 billion to pay for these lifetime costs. Back then, we had roughly this amount in our investment fund, meaning that on paper, we had approximately enough money to pay for the cost of injuries up until 2119. In accounting terms, our books were balanced. Since then, our investments have delivered a 13% return, which has helped grow our investments to $44 billion. However, at the same time, interest rates fell to unprecedented lows, plummeting more than 1% over the course of the year. This had the effect of increasing the value in today's dollars of the costs we expect to face in the future. At the start of the year, when interest rates were higher, our claims liability was $41 billion. By the end of the year, mainly because of the sharp decline in interest rates, this liability had significantly increased by $12 billion to $53 billion. We were able to offset some of this increase with the profits we made from our investment fund, but this still left us with $9 billion less than we theoretically need to meet the cost to treat, rehabilitate, and compensate the people who need our support over the next 100 years. Although we have a gap to close, we do have many years over which to close it. One way will be to earn healthy investment returns. We have an excellent track record of doing this. Another way would be interest rates going up. This seems unlikely in the near future, but a time frame of the next 100 years is a different story. The future is difficult to predict, but what is certain is that we have enough funds today to support those who need our care.
So as you've seen from the video, the ACC's investment team's return of 12.97% could not offset the substantial impact of the fall in interest rates had on the scheme's liabilities and the funding ratios of the accounts. This result for the investment team has again demonstrated their ability to help reduce the cost of levies for Kiwis who have had accidents. Every $100 that ACC has invested 27 years ago has effectively grown to be worth more than $1,350 today. That translates to compound returns of over 10% per annum. The size and scale of the deficit was not something ACC could predict, prevent, or fully hedge against. Because the OCL is the lifetime cost of supporting all existing injury claims 100 years into the future, it's highly sensitive to changes to long-run interest rates. A lower interest rate increases the OCL, but the opposite is true as well. When interest rates increase, the OCL reduces. As the video noted, interest rates have fallen to historical lows, and the sustained low rates are impacting our balance sheet, as it is many other global insurers and pension funds that invest in bonds and have long-term liabilities like ACC. As the scheme gets bigger, it becomes more sensitive to changing interest rate conditions. However, the long-term nature of our liabilities means we have time to manage this volatility. In 2009, the decline in interest rates caused by the GFC contributed to a substantial revaluation of ACC's claims liability and a $4.8 billion deficit. However, a renewed increase in yields a few years later had the opposite impact. We learned from that experience that the scheme is sustainable and able to be managed on a medium to long-term basis. Therefore, we can respond and reduce the asset-liability gap over the coming years. Due to the long duration of its claims liability, ACC has limited ability to fully hedge against those effects. However, the successful defensive positioning of our bond portfolio has provided considerable offsetting valuation gains during the past financial year. To illustrate the impact of falling interest rates, the 2018-19 financial year saw a 109 basis point decrease in the single effective discount rate, which is the interest rate that is used to value our liability. The effect of this was substantial. The largest impacts were experienced in March, May, and June, where declines in interest rates contributed to the deficit by $6.8 billion. It's too early to say what implications the deficit might have for levies. In the ACC Board's recommendations to the government next year, in recommending levies, the ACC Board will have regard to the underlying costs of the scheme, in other words, what we think of as New Year costs, and the ability to respond to volatility, including falls in interest rates over many years. What's important is that ACC continues to focus on what we can control, improving injury prevention, care and recovery, and relative investment performance. I'm now going to hand over to Scott to outline performance results from the year for the company, including the significant progress we have made on transforming the organization to better meet the needs of New Zealanders. Scott.
Thanks, Dame Paula. Atamarie. Operationally this year, we've included delivering multiple initiatives as part of our organisational transformation, making it easier for customers to engage with ACC and receive our services, including online. This includes a new claims lodgement system, an upgraded claims management system, a new payments function, an advanced data and analytics platform, a digital interface for business customers and clients under MyACC, and a new nationwide case management approach that focuses on the specific and often changing needs of individual clients. I'm going to talk a little bit more about those in just a moment. But also we continue to make progress with Whaia Te Tika, our Māori strategy to create better ACC experiences and outcomes for Māori. We are an entitlement-based scheme, and we recognise that we must continue to do better for Māori. Today, approximately 8% of our claims are for Māori, but of course that equates to around 15% of the population. During the year, we introduced a new navigation service to help Māori understand the scheme better, and that's based on whānau ora principles. We're also looking at how we contract some of our health services into the future by incorporating kaupapa Māori principles. We have specific injury prevention programs with Safe Kids Aotearoa. Our partnership with Māori TV is something that we've had for the last several years to allow us to get additional injury prevention messages out to Māori. And we're working in Tairāwhiti with 4 providers who have iwi-driven kaupapa Māori models driven by Māori values and beliefs. During the course of last year, we also continued to increase our investment in injury prevention programs from $69 million to $75 million. And strong partnerships allowed us to reach more than 700,000 New Zealanders with our injury prevention messages. Today, we have about 104 programs either in delivery or in the pipeline with our partners. The investment that we delivered, an estimated future claims cost reduction of $1.81 for every dollar we invested, our highest return ever. 2018-19 was a significant year for ACC as it received a record number of new claims, passing 2 million for the first time. This includes a 25% growth in sensitive claims, and our weekly compensation claims rose by 5.1%. The total cost of treatment and rehabilitation services also increased, with $2.8 billion spent on claims, up 7.5% year on year. We managed 83,737 new weekly compensation claims and returned 55,141, or 66.8% of injured clients, to work within 10 weeks. High claim volumes linked to strong economic conditions and a growing labour force proved challenging in meeting our performance targets. Improving prevention, rehabilitation and customer experience and outcomes will continue to remain our focus in the year ahead. The investment that we are making in transforming our people, processes, information and technology is all about ensuring that we make ACC as efficient and effective as possible, as well as meeting the needs of New Zealanders, not only today, but into the future. And in the year that has just gone, we've seen the most significant year of activity since we commenced our transformation program in 2014. As at June 30th, $390 million has been invested of our total $669 million program budget. We are confident that we'll deliver what we have committed to under our program within this financial envelope. I just want to give some examples of what has been delivered over the past 12 months. Our new policy levy management system, Juno, went live during the course of this year and became fully functioning. It allowed us to retire a legacy system, and we were able to migrate 37 million customer records for over 530,000 New Zealand businesses onto a modern cloud-based architecture. Significantly, in the digital space, My ACC for Business has already had 2/3 of New Zealand business sign up directly or via their tax agents to do business with us digitally. It allows customers to manage their account, to pay online, to change their details, and importantly, to be able to provide us with real-time feedback. Our client front-end establishment system also went live during the course of the year. This is a simplified claims registration and cover decision process. Most claims we receive today are now lodged digitally, and business rules allow cover decisions to be approved instantly and consistently. The system itself cannot decline cover, and it allows our staff to spend more time on those claims which often only require additional information before being approved. To give you an example of the change that this has made to our customer experience, previously a customer would have to wait somewhere between 5 to 7 days to receive a letter confirming their entitlement of cover. Now with the system that we have, you're able to receive a text message confirming your claim. And the record that I am aware of during the past year is 7 seconds. The customer was still sitting with their GP when they got a text message confirming their claim with us. We've also upgraded our core claims operating platform and increased the functionality of that system to include payments. It's easier now for our staff to navigate and to be able to provide better customer services. It also provides us with a strong technical base for other program delivery. We also delivered our first client payments functionality, which allows customers to set up and process weekly compensation much faster. We've simplified processes, we've improved payment accuracy, and importantly, we've been able to link with the transformation program in Inland Revenue to provide and receive real-time earning data. Importantly, we've also de-risked and replaced custom-built legacy systems from 1997, which uses obsolete language. Phase 2 of the program will go live in November. A core part of our customer-led transformation was the redesign of our case management model, which has not been reviewed for over 20 years. This model has been designed to engage with customers to add the most value to their recovery. It has simplified, automated processes which allow staff more time on quality conversations and decision-making with customers and less time on administration tasks. Importantly, we've taken the opportunity over the last 2 years to test this proposition in a live environment called a Launchpad in both Hamilton and Hastings. We've had 105 staff involved in this program, and over 30,000 claims have been processed from low complexity to high complexity. And we have seen a significant improvement over our business as usual case management model. Customer satisfaction is at 87% versus 78% for our current model. In terms of rehabilitation performance, we've seen 1.7 fewer weekly compensation days for less complex claims, and importantly, 12.9 days reduction in higher complexity claims. 95% of our clinical and technical opinions are received within 5 days. Importantly, it has also been fantastic for staff engagement. We're supporting the rollout of this model in tranches to ensure that we de-risk the delivery. 4 weeks ago, the model went live in our launch pad, and just this last Monday, we went live in the southern region of New Zealand, and we will progressively roll this program out over the next 12 months. A significant focus in the year ahead is our relationship and engagement with our providers, who in many ways are the gateway to ACC. But during the last 12 months, we have successfully had proof of concepts in play. And one that I'd like to talk about today is the GP digital referral for MRIs. What we're able to do is manage customers within primary care. We've seen a 16-day reduction in median treatment times, from 19 days down to 3 days. And importantly, we've seen a 40% increase in Māori and Pacifica between the ages of 15 and 30 being able to access high-tech imaging. We commenced this program in Auckland, and we will be rolling it out over the next 12 months. I'll now pass back to Dame Paula.
Thanks, Scott. We're now happy to take questions if anyone has some. Thank you.
So given that it's likely that interest rates will continue to fall, what does that imply for next year's deficit, and what do these conditions imply for what you're likely to recommend to the government for levies?
Yeah, it's a good question, and when you've had a chance to look at our annual report, you'll see that we put a note in the report that there have been further interest rate reductions since the beginning of this year, which has seen a further increase in the OCL. Interestingly enough, the fund has continued to perform very well because it continues to be positioned for that. But it is a similar story. While the fund has performed, it's quite a stellar performance since the beginning of the year we're in now. As with last year, it's not sufficient to cover the increase that has resulted from the OCL changes since the beginning of this financial year. So I mentioned in my opening comments that when the time comes to look at levies, the corporation will have two primary considerations. But before coming to that, I just want to make one comment. That period in which we look at levies again will be next year. In the lead up to that, the government has decided to review the funding policy. And the funding policy sets the framework in which the corporation's board will make recommendations. The current funding policy, which has been in place for a number of years under this government and the previous government, anticipated the volatility that the scheme inherently faces and put in place a 10-year time frame to move the funding ratios back to the range of 100 to 110%, which is what we consider a fully funded range. There are very good reasons why that was anticipated, and we did learn a lot of lessons from the GFC experience. Over that previous period, you know, I can remember when I first became chair, we had a $5 billion surplus at one point. We went on to have sustained surpluses and quite substantial reductions in levies over many years. So we know that through time there are going to be plenty of levers at our disposal to close the asset liability gap, and we expect that to happen. So we don't know yet what the funding policy will be for the next round of levies. There's no need, absolutely no need to adjust levies in the meanwhile. The scheme is absolutely in a sound financial position, and we have the ability to meet claims now and well into the future. The issue we face in the next round will be twofold. There's two primary considerations. One is what's happening to the underlying costs of the scheme. Those underlying costs are driven by a couple of key things. One is the cost of income replacement when people are injured. It's a key driver of the scheme. That itself is primarily driven by economic activity. When the economy is strong, we have strong claims growth and we have strong growth in income compensation. So we will be looking closely at that. If we look at the recent period, including the year we're in and the previous few years, our levies for a very long period have not reflected the underlying costs of claims. And they haven't done that because we've had headroom provided by the performance of the fund, the outperformance of the fund. That has shielded New Zealanders from the full cost of the scheme. This is something, there's no reason to assume that we won't continue to see a fairly stellar performance of this fund. If we look over the 27 years, ACC has, on average, over 27 years, outperformed its benchmark. The 10% compound return I mentioned compares to a benchmark of 8.8%. So that gives me a high degree of confidence. In terms of the second, besides the cost of claims, another key driver of costs for us in terms of new year costs are health costs. And again, Scott mentioned some of the things that we're doing around the health strategy. And that is absolutely vital to us in terms of continuing to contain the need for levy increases to reflect increased costs of the scheme. Everyone, I think, is well aware that health cost inflation tends to far outstrip general inflation in the economy. And if you looked at the wider health system in New Zealand, that's exactly what you see. It's often as much as twice normal inflation. In terms of health cost inflation that the ACC scheme faces, we work really hard on this. In the year to March, our health cost inflation for elective surgery, which is one of our major healthcare costs, was 0. The superimposed inflation was 0. In other words, our costs were moving at the same rate as wider economy inflation. Anyone who works in the health sector would know that's a stellar result. In the rest of the, in terms of the rest of our medical costs, we saw a superimposed inflation rate of 1%. Again, it's a fantastic result. In fact, it's such a strong result that in last year we had an actuarial release. The OCL was reduced as a result of our performance in the health area by 81 million, and that followed a reduction in the previous year of 41 million. So that those things we will look at, and we will look at how we're positioned this year with those costs. The other part of the puzzle is the longer term puzzle, which is about the OCL. So we know that going forward, we right now are projecting that we have a greater cost that we need to cover. However, we also know that we have time to close that gap. And it's not just to take time because that's convenient to do. It's also the right thing to do for intergenerational equity. We should not, and we will be saying to the government that it should not overreact to short-term movements in interest rates, even if those interest rates right now are projected to be low for some period and potentially go lower. Because our experience since the GFC taught us that we have plenty of levers to pull to close the gap. And those levers are, one, there will be a change at some point in interest rates. Two, Scott's mentioned our injury prevention program. We are investing a significant amount in terms of reducing the number of claims that we might face in the future. Three, claims performance is critical to us. And while this year we've had a record number of claims and we have rehabilitated a record number of our clients, we have struggled to hold rehabilitation rates. And so our investment in a new approach to case management and all of the other things we're doing through the transformation, we can see early results indicating that we will be able to establish clear gains in terms of our claims performance, and that's critical to us. Investment performance is the other lever we have. Obviously, can't always count on your fund performing, but we have almost an unbeaten record on that. And the pleasing thing about that record is we don't take undue risk. It is a low risk strategy that we run. Our returns have less volatility about them than other funds, and yet their returns are at least comparable, if not superior. And finally, health costs. The health strategy that we have put in place is delivering results. The board would like to see that accelerated, and we'd like to see that accelerated for two reasons. One, it's important to our customers. It's very important to their recovery. And two, it's critical to us being in a position where we can continue to ensure that levies don't have to be any greater than necessary. So those are the levers we will be looking at when we decide what we need to suggest to the government in terms of levy setting. The government itself will set the funding policy, and then we will advise them what they need to do in order to achieve that funding policy.
When will they report on that?
The funding policy will need to be set before the next levy round, which is mid-next year. And it's up to the government when it makes the funding policy public. But I think, that funding policy will be made in ample time because it will have to be made clear before the corporation consults on its recommendations, which we will consult with the public on. So my message to you is, despite this deficit that we see, the key factor when we look at levies going forward will be the underlying costs of the scheme. And we will look at an adjustment path to get us back to balance. But that path we are looking at over a very long period. And we do expect that interest rates and the investment fund and the investments that we make in claims performance and the health strategy will carry the brunt of that. That does not mean that we will not ever see levy increases. The way the scheme works is if you think about where we were a year ago, where we were virtually fully funded, in a fully funded context, what drives levies is the changes in the costs of claims. So in that environment, you would be purely focused on that. What are the underlying costs of delivering rehabilitation services at the time? And that's why I stress to you the importance of understanding what's happening to healthcare costs and other factors that drive that. So, this is a situation where we need to remember that those are the critical things in the scheme that need to be managed and that will impact on levies. We have a much longer period to think about how we close the asset liability gap, and it would be a mistake in the view of the corporation to try to close that gap too quickly, and it would have severe intergenerational effects on the current generation if we tried to do that and it would probably be unnecessary. It'd turn out to be unnecessary.
You talked about the decline in interest rates during the GFC, resulting in a $4.8 billion deficit. This is obviously double that. Is this the biggest deficit that ACC's faced with?
The 4.8, there were, like now, there are a number of factors, but it was one of the factors at the time that contributed to that, so I want to be clear on that. But yes, this is the biggest. The scheme is many, you know, is of a size, is of a much greater size now than it was then. So I think we put up a table that shows how the scheme has grown. It's still not mature, so the OCL will continue to grow until the number of people into the scheme matches those leaving, and we've got some time before the scheme is fully mature. That's why we continue to see the size of the scheme grow, and that's still playing out. So you have to be aware of that, because I'm not sure we'll find the numbers for you, but I suspect that the size of the scheme may have as much as doubled in that time.
Over the last 5 years.
Yeah, yeah.
Should we expect a period of sustained losses now?
It isn't a loss. So, no, a deficit, it is not a cash loss. In
No.
fact, we had a cash profit or a cash surplus. It is not a cash loss, and that's really important to say. If interest rates continue to fall, and they have fallen already this year, we will continue to see the OCL increase. That's, you know, that's very clear. Whether they will and how much they will is unknown to everyone. We don't know, and we've seen interest rates. If you look around the world, you do see interest rates falling. If you look at long rates, you see that right now the market's pricing in low rates staying around for a long time. So, you know, it's, I wish I knew how, you know, whether rates would continue to go down. I mean, even in the current financial year, since the beginning of the financial year, while we've seen the effective discount rate go down further, we've also in certain weeks seen it go back up. And the numbers are big, you know, both directions. Unfortunately, them going down is the bigger effect of the two, but, you know, it's uncertain right now which way it's going to be.
What are the implications of that for the long-term financial viability of the scheme in its current form?
I don't think there are any implications. I don't think there's any question that this scheme is sustainable. There's no question at all in my mind. I mean, if you go back 27 years when we started this, and as we've moved towards full funding, there've been plenty of times when we weren't, when at the beginning we weren't full funded at all. But we've over time moved, not always in one direction. We've had ups and downs, but we have continually moved towards a very strong position. And there's no reason to assume that we would do anything other than that. And we have the added advantage that we continue to be sheltered by the performance of the investment fund and the performance of the management team, who continues to invest in ways to contain costs and improve outcomes for our clients. So there's, in my view, there's absolutely no question that the underlying position of the scheme is strong. There's certainly no argument for restricting entitlement, absolutely no argument for doing that. And ACC, it's not to say ACC itself doesn't face strong challenges. If we want to be effective in containing the need for levy increases, we are going to have to work hard, and we are working hard to do that. But this is a matter of how much levies need to change at the margin. It is not about whether the scheme is sustainable.
In terms of the multi-strategy for Antarctica, what is there a need specifically for a multi-strategy within ACC?
Well, one of the things we've been aware of for a very long time is, and we don't understand, is that Māori take up ACC services at a lower level than the wider population. And we have no reason to believe that their injury rates are lower. In fact, in some injury types, we think they may be higher, like in sports. So, the corporation is determined to ensure that Māori access the entitlements that are there for them to take up, but I'll let Scott speak to them.
Yeah, and I think from our perspective, it is, in some cases, it's education, but it is also creating models which will actually fit for Māori as well. And we recognise the need to change, because the model that we may have in a certain area, particularly around rehabilitation, may not necessarily fit with Māori principles. So we're just trying to be more flexible to allow greater access and greater understanding to drive better outcomes for Māori. And it is not something that is a one-year strategy. This is something that we must embed, it must be authentic, and it must be long-term. And that is the commitment that we have under Whaiteke.
You mentioned before that you're working alongside 4 groups and Te Rāwhiti.
Yeah.
Will you be working with any other Māori organisations throughout the country?
Absolutely. So Te Rāwhiti was a pilot program. I've just got some very early data back from that. It looks really positive, and our intention is to continue to look at how we roll out those type of programs throughout the country. But it is important that to gain that evidence base that we needed to pilot it, and the process that we've had in Te Rāwhiti has been very beneficial for us.
Operating costs, according to page 4, were at $1.13 billion, but they were only $749 million last year, so a 50% increase in operating costs. What were the reasons that they did a significant jump?
So our operating costs include our claims costs. So when we have claims costs that have increased, and as Dame Paula has referred to, drivers of that strong economy driving higher claims volumes, as well as inflation. When it comes to our operating costs, people costs is a big cost for us. Actually, over time, as claims volumes increase, we have to manage that claims volume. And how we measure that in terms of our efficiency is how many claims we have for the number of staff. And actually, if we look over the last 5 years, that efficiency in managing those claims has improved by 10%. So although you may see on paper that those costs, people costs may go up, we need to look at that in relation to the size of the scheme as it grows, and because we get more and more claims as the scheme gets bigger and bigger.
So on that you seem to imply that when the economic growth, obviously it drives up claims, what have you, but on the other side though, doesn't it also increase your levy income because there are more people?
Yes, it does. Yes, it does. Viable earnings, and we've also seen an increase in our levy revenue because of that strong economic impact.
But it doesn't offset it though to the same degree?
It doesn't offset to the effect that you've got this interest rate impact.
Yeah,
that impacts the scheme on a larger scale than that.
Any more questions?
One of the things that you guys highlighted was that there was a 25% increase in sensitive claims. Was that because there was more sexual violence, or because you think people were more willing to file claims regarding it?
We have seen that trend for a number of years now. I think 4 or 5 years ago,
Since we redesigned the service.
we redesigned the service to make access to support less onerous, and we've seen an uptake of that. It's really hard to know what the underlying trends are on sexual violence, but we made the change because our strong view is the earlier our clients receive access to services, the more likely they are to recover. It is a difficult area. Those claims tend to be longer lived than most of our other claims. The board and management are committed to providing those services to those clients. We believe in the long run, this will be a good outcome for our clients and for the scheme. But we are seeing, you have to put it in the context that even though the percentage increase is very high, it's a small part of the scheme. If you looked, if you looked at its impact on the overall numbers, it's not large. But having said that, we are absolutely committed to continue to learn how to provide those services.
I think also over and above that, what we will continue to do is look at effective prevention programs as well. We've invested significantly in a program called Mates and Dates, which is about responsible relationships, and we think that the service combined with the prevention is allowing a much better outcome. As Dave Paul said, it's something we continue to manage very closely.